Clover Industries Limited profit for the year ending June more than trebled as a result of strong sales, but the dairy foods maker said it will struggle with higher costs in the coming year. Diluted headline earnings per share totaled 106.2 cents from 33.1 cents a year earlier. The group's revenue improved by 6.1% to 6.5 billion rand, and normalized operating profit increased by 2.4% to 328.6 million rand. A final dividend of 15 cents per share was declared, bringing the total dividend for the period to 43 cents a share.
Clover market cap of 2 billion, price earnings of 9.7 and a dividend yield of 3.9. Warren, let's come to you first. At that top level, headline earnings per share plus many hundreds, etc. But there's a whole lot of accounting stuff that's really happening there. The numbers, if we strip out all those specials, come in at a little more modest.
Absolutely, yeah. And obviously that's a figure that the company wants to advertise, is that headline earnings per share went up so much. But I think if you delve into the numbers and you just look at the nominal figures year on year, you'll see that revenue only increased by 6.1%. So that's roughly in line with inflation. And then the profit from continuing operations, which wasn't advertised very much, has actually declined by 40%. So what the company's been doing is it's been in transition, and they've also had some accounting technicalities which has bolstered that HEPS number. But if you actually look at the operations year to year, it hasn't really produced any fireworks, and I think that's typical of quite a defensive company. So this is, Clover's only been listed just over a year. We were talking about it earlier. It's a very defensive type of company because it sells a lot of foodstuffs, and I personally don't think there's any fireworks to be seen in this share. So I'm pretty conservative on what I'm expecting from the company going forward.
Well, just staying on that balance sheet, Warren, the company is very lowly geared. I mean, the DE ratio is 25%. Surely that's a company that is poised for expansion.
Yes, the balance sheet, obviously they've paid down some debt following the listing. They've also bolstered, they needed some more money for working capital. But in terms of where the revenue growth is going to come from, we know that they've got the project where they are aiming to save up to 100 million rand a year by moving their facilities closer to their sources of production, closer to the farmers in the Eastern Cape and KwaZulu-Natal. So for me, this company's more a stock about how they're going to increase earnings by savings, as opposed to how are they going to increase earnings by growing revenues. And when you're selling foodstuffs, there's limited upside to growing revenues quite aggressively. They do have what we call value-added services, is where they're taking the raw product, like raw milk or fruit juice, and they're creating their own fruit juice lines and then marketing that and distributing that. But I just can't see how they're going to grow revenue aggressively. So for me, I'm looking at what are the cost savings going to be, and then valuing the company on that, because I can't see aggressive growth on the top line.
Chris, isn't that broadly what food companies are? Very, very defensive and lacking fireworks. I mean, Clover's got some massively strong brands. We can touch on that in a bit. These are going to be defensive players, Pioneer and Tiger.
No, exactly. And Clover's more a niche player in the actual food distribution industry. They're also quite uniquely positioned in the sense they've got strong links both vertically and horizontally in terms of their horizontal and integration, with the suppliers and with the end customers. And for that reason, I think they've got a fair bit of flexibility to manage their operations to cope with cost rises and that kind of thing. So in terms of defensiveness, I think it is one of those. It's got a very short listing history, but certainly that can develop into a blue chip over time. I would think growth opportunities are there, but it would have to be on the export side. In other words, to do it, you'd have to expand the supply base.
Export into Africa?
Export into Africa,
I mean, they're
yes.
Talking Nigeria with some of their juices and the like.
Absolutely. Africa is where the growth is and where it's probably easiest to penetrate markets. In terms of how deep you have to put your hands in your pockets to actually build market share in an African country, and when you are still building even a small country like Malawi, for instance, or immediate neighbouring states, etc. It's for a company like Clover, that actually can mean growth at the margin.
We talk about margins, operating margin for the whole, Warren. Let's come back to you, 5.8%. Modest, but I suppose that's what you get in the food space broadly.
Yeah. I mean, it's a very competitive market. The rationale is obviously that they're moving this the cost base or closer to the manufacturers or the farmers, so they're going to save on logistical costs. But there's only a certain degree of elasticity, if you could call it that, in food prices. Unless you go the Woolworths route and you really offer a superior product where you can then charge for that, you can go that route. But what they're doing is they're competing with a lot of the status quo in the market. So they've got their own fruit juice brands, they've got Tropica, they've got Clover. Clover already commands a premium. How much more can you charge per litre of milk to a consumer? It's ultimately a commodity. So that's why I think there's very limited upside on the revenue side of things. And hence the reason, for people that are wondering in the current macroeconomic environment for companies that will be able to grow dividends, this could be a great company because its revenues, its earnings base is very protected. As we mentioned, it's very defensive. And there is a good chance that they can continue to grow dividends, but I'm not expecting any fireworks. So I'm going to see, I'll be happy if they can grow their revenues between 5 to 10% in the next few years going forward.
So Warren, could we say that you don't think that the stock is hot then?
We looked at it just post the listing. I think in January the share price was at 11 Rand. It's at 11 Rand 10 today, or 11 Rand 08. It came out with the HEPS number today in the market. Its share price declined by, I think, 0.4%. So I think the market's also believing this, and that's why I think it's not hot.
Not hot for you. What about you, Chris? Hot or not?
As a defensive play, it's probably not because of track record. It's to establish itself as a blue chip, etc. I think it needs a bit more track record, and there's some spin in the accounting numbers, so one needs to unpack that a little bit. So I would tentatively put it as not hot, but I would be careful. In the defensive play, it may well be something to look at in the future.
Simon Brown, you're not lactose intolerant. How do you feel about Clover?
No, and I have milk in my coffee. When Clover first came 6 months ago, I had Keith McLachlan. I said not hot, and I'm going tentative hot. It's not going to set the world alight, but milk is there. It's nice defensive. There's cost savings there some way down the line still. But that dividend yield 3.9 attracts me as well. So I'm going to give it a tentative hot, which kind of leaves us in the middle of nowhere.
Tentative hot for Simon and 2 not hots from each of our guests. Moving on to Clover Africa now. They grew its revenue up 166% to 1.97 billion Rand for the year ended 30 June. Gross profit was 40% higher year on year at 286 million Rand. The group focuses on 3 core areas: exploration, development and mining. It continues to work towards becoming the primary South African coking coal exporting company.
Market cap for Clover Africa, 3.9 billion in negative price earnings, because although they had a gross profit, when you start doing all the accounting tricks, you get a headline loss of 41 US cents and a dividend yield of 0, not paying a dividend. Warren, let's come to you. Really, their modus operandi is to operate some of their mines and make revenue from that, and then do the exploration and the other side. And they've had all of those problems with Department of Mineral and Energies, with the water, with sand parks, etc., with their Vele colliery. That's kind of coming right. There's still an appeal out there, but it looks like that seems to have solved itself, and now they can get on with their business there of pulling coal out the ground. Yes,
yeah. It's obviously what you're getting with this company at the moment is that it's a thermal coal producing miner. So it's selling thermal coal into export markets, and a small portion of that, or some of that's going to a local power station, which is just down the road from one of its operations. And then as you said, it's had these problems with environmental groups, the water license being suspended at Vele. For me, it's a company that's fast developing some street cred as the management team negotiates some of these things. And they've been successful in doing that. They signed the memorandum of understanding with Sand Parks around operating there, having this operation close to a national heritage site. So you've got to give them kudos for that. They came out with production guidance earlier on this year. They said they were going to do 4.5 million tonnes in production.
Yep.
They hit that number. So yes, there are problems and there's risks associated with this company, but it is it is a company that are fast developing street cred. And what I particularly like is that some of their development projects, notably Mercado and the Vele colliery, which we've mentioned, has exposure to not thermal coal, but coking coal, or met coal as it's called. And I think that's quite interesting. They've also had their export quota through Maputo increased threefold. And that's the trick with a lot of coal mining projects, especially the coal juniors, is that they're trying to get their stuff on board and out of the country is proving to be very challenging with some of the bottlenecks at Transnet Freight Rail. But this goes via Maputo. It's a bit more expensive for them to go that way, but nonetheless they can get the stuff to port.
Chris, coking coal, that really is it. Everyone seems to be producing coal for Eskom. That doesn't work. And that's why, I mean, ArcelorMittal is sitting there at a 16% shareholder.
Yes.
You can tell they're eyeing the coking coal.
Exactly. That metallurgical coal is, in fact, it certainly differentiates the product. It's an important thing. You cannot really produce steel without it. The fact that they're overcoming the regulatory problems is important. I suppose from the other side, it's how not to do regulation. In other words, to put, spoke, one needs to find how can one reinforce this and also mitigate some of the concerns that that the regulators bring in. But that I think is the biggest uncertainty overhang over coal. And I think, or Coal of Africa, and the importance is that as that clears and you get more certainty as to what the risks are and the costs, etc., that you will find that that this gains more and more momentum. It's in the right sector. Energy is a great sector to be in because I think if you say the oil price leads it, the oil price has got a natural underpin because of the marginal cost of producing oil and the huge expansion in demand. Even if the global economy does turn down, there's probably an underpin to energy prices in any case, and that will stand this company in good stead as well.
Well, the company's impairment losses and depreciation charges were higher for the year ended 30 June. And I know obviously those are just accounting figures, but higher rail and port costs, do you think that those will be necessarily offset by the export sales?
I think so, because I think a combination of high product prices and also, and I think you'd also do better on coking coal as well. That's also important, is that you're being a specialised product, you can command some margin there as well. So it's not quite the commodity that thermal coal is, and so I think these things are all manageable. And one can cope with it. But again, logistics in this country, I think, is a constraint to the entire coal industry.
Logistics being Richards Bay Coal Terminal, having to go through Maputo,
getting it onto
Eskom,
rail, etc., Eskom, the whole lot. There's a problem with that. But nevertheless, Eskom is a customer of theirs, and they're able to get some product
and
to
so
them.
Based on that,
Yes.
Chris, would you say that it's hot or not?
I think it's hot, yes. I think very much I like this one.
The Coal of Africa was down 0.81% on the day. Warren, does that affect your view on whether it's a hot or not stock?
No, I think it's definitely an investment for the medium term, and so I'm hot on Coal of Africa as well.
Two hots for Coal of Africa. Simon, how do you feel about the stock?
They're coming in together. There's a lot of coal stocks in South Africa. I've typically been an Exara fan. I don't like the mid and small guys, but I think of the mid, I think the point that Warren made, that the management are a lot wiser and a lot smarter. All those exploration projects, some 8 of them, they're going to do them a heck lot better going forward. I think if you want energy and you don't mind a little bit of volatility in your price, Coal of Africa, we'll give it a hot.